Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad ZUHAIR. To begin with our presentation, I start with the introduction. So, we are doing an audit planning on Aeon Corporation Berhad, or also known as Aeon. Aeon is a company listed in Bursa Malaysia from the main market and from the sector of consumer products and services. Aeon was first incorporated on 15 September 1984 and it was set up to help modernize the retailing industry in Malaysia in response to the nation's government's invitation to Aeon Japan. Aeon is a leading retailer in Malaysia with total revenue of 4.539 billion for the financial year under review. Aeon basic principles are respecting humanity, contributing to local communities and pursuing peace, with its core being the customer's point of view. Aeon's business is principally engaged in the retail operations of chain of departmental stores, supermarkets, pharmacies which sell merchandise with a broad range from food, pharmaceutical products, household products, clothing and many more.
Assalamualaikum warahmatullahi wabarakatuh. My name is AFIZAN bin MUSTAMIN. I will be presenting on the materiality. First of all, revenue is chosen to be the benchmark used in determining materiality as Aeon is a profit-making client. If the combined misstatements of revenue are less than 45,389,000 ringgit, the statements will be considered as fairly stated. But if the combined misstatements of revenue are more than 90,778,000 ringgit, the statements will not be considered as fairly stated. If the combined misstatements of revenue are in between, the professional judgment is needed. There are two arbitrary requirements have been established in allocating performance materiality levels across segments of the financial statements. The first one is performance materiality for any account cannot exceed 55% of the preliminary judgment, which is 49,928,000 ringgit. The second one is the sum of all performance materiality levels cannot exceed twice the preliminary judgment about materiality, which is 181,556,000 ringgit. Our group has conducted performance materiality levels for each account in the statement of financial position of Aeon. From the above data, account receivables, deposits, and prepayment and inventories were allocated with a large amount of performance materiality of 49,928,000, as these accounts have a huge and complex number of transactions with an expected misstatement. This will result in a lower cost of the audit fees and extensive sampling will be used in auditing the accounts. A large amount of performance materiality was allocated to the right-to-use assets, other investments, share capital, deferred tax assets, contract assets, and some accounts in liabilities. These accounts have little volume and information are easy to be collected. This will result in an extremely lower cost by using substantive analytical procedures. A small amount of performance of materiality as percent of account balance was assigned to PPE and intangible assets, as these accounts have little change from the prior year and are not difficult to be audited.
Assalamualaikum warahmatullahi wabarakatuh. I'm going to continue to talk about the inherent risk of Aeon Co Malaysia Berhad. The first factor that can be found is from the nature of the company itself. Aeon Co Malaysia Berhad provides retail stores across the globe that sells household products, clothing, food and many more. However, there is a possibility of obsolete inventory that the products are unsold or will not be sold in the future. Other than that, the second factor is repeat engagement. This can be found from the KPMG Desa Megat that audited the company for several years. So the material misstatements has been corrected and fixed. Therefore, the amount of inherent risk has been lessened. Third factor is about the related parties. Related parties of Aeon Co are Aeon Fantasy and also Aeon Top Value. There is a high possibility of the transactions between them are not fully disclosed. Complex transactions such as property management services will be hard to deal with because of the amounts of brands in Aeon. So there will be a possibility of mistakes being made when recording the transactions. Furthermore, there are a lot of accounts that counted at a fair value, such as asset impairment, inventories, accounts that need to be calculated again. The inherent risk of the company is increased. The last factor is about the makeup of the population. Makeup of the population is talking about the overdue accounts of the company, trade receivables and intercompany loans. Accounts like this that are recorded with overdue amounts will increase inherent risk because of its difficulty to be calculated.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Zubaidah binti Kamaludin, and today I will be presenting on the liquidity and profitability ratios of Aeon Co Malaysia Sdn Bhd. Firstly, I'll be talking about the cash ratio of Aeon. This ratio evaluates the company's ability to pay their short-term debts with cash or cash equivalents. So from 2017 to 2018, there is a slight increase of 0.001%. However, it decreased in 2019 from 2018 by 0.009%. Moreover, the company has a ratio of less than 1%, which means they can only finance a portion of their short-term debts. Moreover, it shows that the company's cash is only utilized for paying off their short-term debts, and they are not able to have any extra to be invested in other investments. Quick ratio measures the company's ability to finance the short-term debts using their most liquid assets, which excludes inventories from their current assets. Since 2017, this company's quick ratio seems to be decreasing from 0.073 to 0.047 in 2019. This shows that the company is decreasing in their ability to pay off their short-term debts. Besides, the company has a quick ratio of less than 1, which means that there are insufficient amounts of current assets to finance their current liabilities. Next, the current ratio of the company. The current ratio measures the company's ability to pay off their short-term obligations using their current assets. For 3 years, their current ratio remains fairly consistent. So the ratios in 2017 to 2018 increased by 0.02% and remained stagnant at 0.36% from 2018 to 2019. These numbers shows that the company has too little liquid assets to finance their short-term debts, as the ratios are less than 1. Next, the gross profit margin. The gross profit margin shows how much money is left after subtracting the cost of goods sold. A slight decrease is shown throughout the 3 years. It may have been due to an increase in the cost of goods sold over the 3 years. Next is the profit margin of the company. The profit margin ratio shows how much of the sales or revenue actually becomes profit. For Aeon, shows that only small portion of their sales actually becomes profit. From 2017 to 2019, only 6%, 5% and 8% of their sales become profit. Over the 3 years, their profit margin shows some fluctuations, however, it is not excessive. For return on assets, Aeon is showing a decline by 0.01 from 2017 to 2018 and remains constant in 2019. Following ROA could be linked to the fact that the company just started leasing a number of shopping malls and outlets, which causes the total assets account to increase by 40.7%. The ROE of Aeon is also decreasing from 2017 to 2018 by 0.09 but surged to 0.11 in 2019. The decline may be explained by an excess debt of contract liabilities, which are customer loyalty awards and rebates that have not been redeemed by them. Inventory turnover for Aeon has recorded 4.07 in 2017 and increasing slightly at 4.26 in 2018. However, in 2019, it seems to be decreasing to 3.74 and could imply a sign of overstocking or deficiencies in their products, as they have a large number of inventory balances. Aeon's accounts receivables indicates a fluctuating trend where it decreases in 2018 and increases in 2019. indicating an efficient business operation because they are collecting receivables more frequently and the money they collected can be used sooner to pay their other obligations. It has a collection period that shifts from 3.56 in 2017 to 4.25 in 2018 and later to 4.0 in 2019. In general, it shows a low collection period, meaning Aeon is fast in collecting their payment. Next, I will be presenting on how our findings will affect our field audit. I will be explaining on 4 of them. First of all, for Aeon's property, plant and equipment, it shows an increase of 5.58% from 2017 to 2018 that may be due to new acquisitions of PPE in 2018. During the audit, auditors can make site visits to ensure the existence of these PPEs, and they should also go through the sales and purchase agreements related to these PPEs to gather the correct value. Next, there is a significant balance of inventory from 2017 to 2019. This may be due to a large sum of estimated loss from slow-moving or obsolete inventory, and with that, auditors should recheck with the company on how the estimated loss of inventory is defined and calculated. Besides that, they should also be present during the company's physical inventory counts to verify the existence of the slow-moving and obsolete inventory. The third area of concern I will be explaining is the increase in contract liabilities account. There is an increment in the contract liabilities account from 2017 to 2018, and this is due to the amount of unredeemed points and rebates by customers. In this situation, auditors should recompute the calculation of key points and rebates that have been calculated by the company and reconfirm with a tax consultant on the amount allowed for rebates and vouchers in order to verify this increment. And lastly, for current tax liabilities, there was a 24.88% increase in the current tax liabilities account from 2017 to 2018, and also a huge decrease of 59.97% from 2018 to 2019. This gives signal to auditors that there might be possible misstatements in this account. Due to the possibility of large misstatements, more auditors should be assigned to this account to reduce the likelihood of error. And auditors should also widen their sample selection to help minimize sampling risk. The next area of concern is the right of use of asset account. The 100% increase in the account of right of use asset might have been due to the recent addition of new right of use assets in 2019. So during audit, auditors should inquire third parties such as the lessee of the right of use assets for confirmation on the amounts attributable to the right of use asset contract. And next is the other investments account. The increase in 2018 might have been due to the change of the classification of equity security, which was before this classified as available for sale investment back in 2017. However, the decrease in 2019 was due to the decrease in fair value of the equity security that the company has. So, during audit, auditors can choose to assign a more experienced auditor in performing audit for the other investments account. They might have more experience in detecting material misstatements in the account as they can trace back the recording of the particular transaction. Next is the deferred taxes account. The increase in deferred taxes account was because it was only recognized in 2018 and then carried forward into 2019. This is due to the differences in the taxable income and accounting income. For audit, auditors can check in with the Inland Revenue Board of Malaysia to check the taxes due to IRB by Aeon Sdn Bhd. This will give them accurate calculations of the taxes due to RIB and the actual tax paid by them based on the profit of the year. Next is the depreciation of right of use asset account. The increase of 100% for depreciation of right of use asset account is due to the addition of the right of use assets in 2019. So the concerns with depreciation accounts and amounts are usually because of it is a provision. Hence, some possible misstatements could arise if the calculation is not according to the depreciation policy adopted by the company. So during audit, auditors can review the depreciation rate, as in whether it is at a reasonable rate, and compare it to the tax rate provided by the IRB. The accumulated depreciation should also be reviewed as to whether there are any mistakes in the calculations, as this amount is material to the net book value of the asset. Lastly, auditors can also recompute the depreciation amount to ensure the correct amount is recorded.
These are also some of the accounts that need special attention from the auditors.
Alright, so to conclude, we learned a lot of things from this assignment, such as the audit planning process and fundamental concept in auditing. So first of all, before starting an audit, we need to first identify the nature of the business and the industry that they are involved in. This will help us in making rational judgment when it comes to professional skepticism in investigating, planning, and performing an audit work. As every auditor has their own judgment and ability in deciding the information to be audited, communication and cooperation between each member of an audit team is the key in doing effective audit planning and performance. Furthermore, we also learn on how to conduct assessment of risk on materiality and inherent risk, performing preliminary analytical review, and evaluating our findings from the audit planning process. That's all from us. Thank you.